Imagine waking up one day and realizing you've done everything people told you would lead to financial success. You worked hard, built a career, paid your bills, maybe you even saved a little each month, yet years have passed and real wealth still feels out of reach. Meanwhile, someone earning almost the same income is quietly becoming financially independent. The difference usually isn't luck, it isn't intelligence, and it isn't a secret investment. More often, it's the money lessons they accepted and the dangerous ones they refuse to believe. Because the biggest financial mistakes rarely look reckless. They look responsible. They look normal. Sometimes they even look smart. Until one day, they quietly cost you years of financial freedom. In this video, we'll uncover 4 dangerous money lessons that destroy wealth without most people ever noticing. You'll see why earning more doesn't guarantee becoming richer, why playing it too safe can actually make you poorer, how debt quietly steals your freedom, and why time, not money, is the most valuable asset you'll ever own. By the end, you may never look at your financial decisions the same way again. Welcome back. If you're serious about building lasting wealth instead of simply earning a bigger paycheck, you're in the right place. Let's get started. One of the most dangerous beliefs about money is also one of the most common. The more you earn, the wealthier you'll become. It sounds obvious, but reality tells a different story. Every year, people with 6-figure salaries file for bankruptcy. Professional athletes lose fortunes. Executives retire with far less than anyone expected. Their problem isn't a lack of income, it's confusing income with wealth. Think of your income as water flowing into a bucket. Most people spend their lives trying to increase the flow. They work overtime, negotiate raises, switch careers, start side businesses. There's nothing wrong with any of that. But what if the bucket has holes? Every impulse purchase, every unnecessary subscription, every luxury bought to impress other people, every expense that becomes a permanent habit. Those are the holes. No matter how much money comes in, it keeps flowing back out. And that's exactly what happens when income rises. The paycheck gets bigger. So does the lifestyle. The apartment gets upgraded. The car gets newer. Vacations become more expensive. Dining out becomes routine instead of a treat. None of these choices feel irresponsible on their own. In fact, they often feel deserved. After all, you've worked hard. Why shouldn't you enjoy the rewards? The problem isn't celebrating success. The problem is turning temporary income into permanent expenses. Economists call this lifestyle inflation, but its real danger is psychological. Human beings adapt incredibly fast. The car you couldn't stop thinking about eventually becomes just another way to get to work. The dream home becomes your new normal. The latest phone loses its excitement after a few months. The happiness fades, the monthly payments don't. Without realizing it, many people spend years earning more while making almost no financial progress. Their income grows, their expenses grow, and their freedom stays exactly the same. That's why 2 people earning the same salary can end up living completely different lives 20 years later. One spends each raise as soon as it arrives. The other uses every raise to buy assets, invest, and increase ownership. One builds a lifestyle, the other builds options. Real wealth isn't measured by how much money passes through your hands. It's measured by how much you keep working for you after it's earned. The truly wealthy understand that every dollar has a choice. It can finance today's appearance or tomorrow's freedom. Trying to do both at the same time is much harder than most people realize, because money follows priorities, not intentions, and sometimes the safest financial decision isn't earning more. It's refusing to let your lifestyle grow as fast as your paycheck. Dangerous money lessons that can destroy your wealth. Most of us grow up hearing the same advice. Save your money. Play it safe. Don't take unnecessary risks. On the surface, that's excellent advice. An emergency fund can protect you from unexpected setbacks. Living below your means creates breathing room. Financial stability matters, but there's a point where safety quietly turns into a trap. Imagine 2 people who both save consistently for 20 years. The first keeps every extra dollar in a savings account because it feels secure. The second also keeps an emergency fund, but invests the rest in a diversified portfolio, understanding that wealth is built over decades, not months. Neither person is chasing quick riches, neither is gambling. They're simply making different decisions with the same goal. 20 years later, their financial lives look nothing alike. Why? Because inflation never takes a day off. Every year, everyday life becomes a little more expensive. Groceries cost more. Housing becomes more expensive. Healthcare rises. Education follows. If your money grows more slowly than the cost of living, You're quietly losing purchasing power, even if your bank balance keeps getting bigger. That's what makes this mistake so dangerous. Nothing feels wrong. Your account statement may even look impressive, but the buying power behind those numbers slowly disappears. The greatest risk isn't always losing money. Sometimes it's allowing your money to stand still while everything around it moves forward. Fear often keeps people stuck. I'll invest when the market settles down. I'll wait until the economy improves. I'll start after I learn a little more. Each reason sounds sensible, but together they create a habit of waiting, and waiting has a cost. Because while you're waiting for certainty, time keeps moving. The wealthiest investors understand something many people never fully accept. Every financial decision carries risk. Investing has risks, but doing nothing has risks too. The goal isn't to eliminate uncertainty. That's impossible. The goal is to make thoughtful decisions and stay consistent long enough for time to work in your favor. No one knows what markets will do next month. What history has shown, however, is that patient investing has consistently rewarded people willing to think in decades instead of headlines. In the end, the greatest financial danger isn't always making the wrong move. Sometimes it's never making one at all. And that's exactly how many people unknowingly trade long-term wealth for short-term comfort. When people hear the word debt, they usually imagine credit card balances or overdue bills. But the most dangerous debt rarely looks like a problem when it begins. It often arrives disguised as convenience. Zero down, low monthly payment, no interest for the first year. Those offers don't sound dangerous, they sound harmless. Maybe you get a raise and decide it's finally time to upgrade your life. A newer car, a nicer apartment, a bigger television, new furniture financed over several years. Each monthly payment feels affordable on its own, so you keep saying yes, until one day, a large part of your paycheck is already spoken for before it even reaches your bank account. That's when many people discover the difference between being able to make a payment and being able to afford something. Real affordability isn't about surviving the monthly bill. It's about making a purchase without sacrificing your future opportunities. Every financial obligation reduces your flexibility. Changing careers becomes harder. Starting a business feels riskier. Taking time off becomes almost impossible. Not because you lack talent, but because your lifestyle now depends on every paycheck arriving exactly on time. Debt isn't always the enemy. A mortgage on a home you can comfortably afford, a business loan with a clear return, an education that genuinely increases your earning power. Those can be valuable financial tools. The danger comes when debt is used to finance consumption instead of building assets. One creates opportunities, the other quietly takes them away, and then comes the second mistake, waiting. People tell themselves they'll start investing after they pay off a few things, after they earn a little more, after the economy improves, after the market drops, after life becomes less busy. Every reason sounds reasonable, but together they create one of the most expensive habits in personal finance. Doing nothing. The perfect time almost never arrives. Markets rise, markets fall, interest rates change, the headlines never stop. If you keep waiting for certainty, you'll spend years standing still while time keeps moving. Successful investors don't wait until they feel completely confident. They learn, they make a plan, then they begin, because they understand something simple. You don't have to make perfect financial decisions. You just have to avoid letting indecision become a permanent strategy. Before making your next major financial decision, ask yourself one question: will this choice make my future self wealthier or simply busier? That single question has the power to prevent years of unnecessary financial regret. Yet years later, the first person often ends up with significantly more wealth. Not because they earned more, not because they found better investments, but because they gave their money something priceless: time. This is where many people make another costly mistake. They let emotions decide what logic already settled. When markets fall, fear tells them to stop investing. Yet years later, the first person often ends up with significantly more wealth. Not because they earned more, not because they found better investments, but because they gave their money something priceless: time. This is where many people make another costly mistake. They let emotions decide what logic already settled. When markets fall, fear tells them to stop investing. When markets surge, greed convinces them to chase whatever everyone else is buying. The result is a cycle that repeats generation after generation. People buy when prices are high because everyone feels optimistic. Then they sell after prices fall because everyone feels afraid. In other words, they buy high and sell low. Not because they aren't intelligent, because they're human. The investors who build lasting wealth aren't fearless. They're disciplined. They understand that markets will rise, markets will fall. Headlines will always predict the next crisis. But a long-term plan shouldn't change every time the news does. That's why consistency beats excitement. Small decisions repeated for years almost always outperform big decisions driven by emotion. Skipping one unnecessary purchase, investing one more month, learning one new skill, living slightly below your means. None of those actions seem life-changing today, but over the course of 10, 20, or 30 years, they become extraordinary. That's the real secret behind wealth. Not one brilliant decision, thousands of ordinary ones, made consistently. They don't destroy wealth overnight. They do it slowly, one purchase, one delay, one emotional decision at a time. The good news is that wealth is built the same way. One smart decision, one investment, one disciplined habit, repeated consistently over time. Financial freedom isn't about being perfect, it's about making slightly better choices than yesterday, and continuing to make them long enough for time to reward your patience. Before you leave, ask yourself one simple question. Which of these money lessons have you been following without even realizing it? Let me know in the comments. And if you're interested in practical, timeless ideas about building wealth, not chasing quick riches, subscribe and join us for the next video, because the habits that create financial freedom are often the ones nobody talks about. Until next time, keep thinking long-term, because your future wealth is being shaped by the choices you make today.